All right, so welcome to Chapter 3 of the Conduct and Practices Handbook course. This chapter is all about the Canadian regulatory framework. We're going to start by looking at the three general principles of securities regulation. So first off, you have disclosure of facts that investors need to make reasoned investment decisions. So basically, this is saying that as a registered representative, you need to give the disclosure of facts to your clients. And this can be in the form of fund facts or prospectuses and things like that. Number 2 is registration of securities dealers, advisors, and other stated categories of registration. And this is just saying that, of course, you need to be registered in order to not only purchase and sell securities for clients, but also to give advice as well. And 3 is enforcement of securities laws and administrative policies. And we do have, or in Canada, we do have various different administrators which do administrate and enforce the rules in the investment industry, which we will talk about later on. Now, 3 key players in the Canadian securities regulation. First off, the federal government. There isn't actually a formal federal securities regulatory body in Canada. Canada does it by provinces, so each province will have its own administrator. Certain security activities are regulated by federal legislation, though, such as FinTrack. You also have the integrated market enforcement teams, and they work closely with the RCMP and the federal government to help detect, investigate, and deter capital markets fraud. You also have the Joint Serious Offences Team, or JSOT, which is an enforcement partnership between the Ontario Securities Commission. So that, again, is one of those provincial administrators for Ontario. And they work with the RCMP, and their goal is to investigate and prosecute serious violations. So you do have some key players in the Canadian securities regulation. First off, as I mentioned, each province does have their own administrator. For example, in Ontario, you have the OSC, Ontario Securities Commission. BC is British Columbia Securities Commission, and of course, each province has their own name. Now, along with that, you do have the Canadian Securities Administrators, and this is sort of like the overarching body of all of the provincial administrators, and they will protect investors from unfair, improper, or fraudulent practices. So again, they are just enforcing the rules in the investment industry. They also foster fair and efficient capital markets, reduce risk to the market's integrity and to investor confidence in the markets. And the CSA, they use 3 primary tools: the passport system, the Super Memorandum of Understanding, or SuperMU, and also the various electronic databases, which we will be looking at in this next slide. So some of the CSA tools. The passport system, it is designed to reduce unnecessary duplication in the review of filings made in multiple jurisdictions. So basically, it allows them to keep track of reviews that were made in different provinces. You also have the SuperMU. It is a memorandum of understanding about the oversight of the marketplaces, and each recognized marketplace has a principal regulator responsible for its oversight. So, for example, the Ontario Securities Commission regulates the TSX, and IIROC, ASC, and BSC regulates the TSX Venture. Now, the CSA does have various electronic databases. They do use CDIC, which is an electronic filing system for mandatory filings. Every public company do need to publish things like earnings reports on CDIC. You also have the system for electronic disclosure by insiders, and this is where you will file, or you'll find insider reports, or insiders would file their reports within this system. You also have the National Registration Database, or NRD, and this is an electronic database for dealers, underwriters, advisors, and individuals to submit registration applications, changes, etc. So, for example, when you do become licensed as a registered representative, you will be doing it through the National Registration Database. You also have the CTO National Database, and this keeps track of cease trade orders, which we will talk about in a later chapter. In terms of international activities, you do have the International Organization of Securities Commission, and they regulate more than 95% of the world's securities markets, and their objective is to cooperate in developing, implementing, and promoting adherence to internationally recognized standards of regulations. And the International Organization of Securities Commission, they do have more than 200 members, including the OSC, IIROC, and MFDA. Next is the Financial Stability Board. So their mandate, they assess and address vulnerabilities affecting the financial system. They promote information exchange among authorities responsible for financial stability. They monitor and advise on market developments and their implications for regulatory policy. And they advise on and monitor best practices in meeting regulatory standards. And so next you have IIROC. So IIROC's responsibility, they do conduct financial compliance reviews and set minimum capital requirements. They conduct compliance reviews to ensure that registered representatives must follow the Know Your Client and suitability rules. They assess whether trade desk procedures comply with the Universal Market Integrity rules. IIROC does have a whistleblower service as well to evaluate reports of systemic wrongdoing. And then the U.S. counterpart of IIROC is FINRA. You also have the Mutual Fund Dealers Association, or MFDA. This is a SRO, and it is responsible for the distribution of mutual funds by its members in Canada. The MFDA does not regulate the mutual funds themselves. This responsibility does remain with the Securities Commission, but they are only responsible for the actual distribution of the mutual funds. And in Quebec, it is regulated by the AMF. Next, we're going to look at designated stock exchanges. So it does talk about this a bit in the textbook. And only securities listed on a designated exchange are eligible to be held in registered accounts, like RSPs, TFSAs, things like that. You also have, LIRAs and LIFs. And the exchange must carry out the normal business of an exchange in listing securities. So that's what a designated stock exchange, basically the definition for that. It must have acceptable standards for new company listings. It must follow investor protection, disclosure documents, and the IOSCO. It must have sufficient financial resources to ensure long-term viability. It must have a range of listings and adequate liquidity for investors to buy and sell securities at reasonable bid-ask spreads. Now, foreign-based exchanges. So the host country must have commercial, legal, and tax relations with Canada. The host country must be a member in good standing in the international financial community. The securities regulatory framework must provide rights and remedies to Canadian investors. The exchange must be recognized by the host government and other foreign governments, and the host country must be at low risk of imposing capital restrictions. Now, you also have the Canadian Investor Protection Fund, and this is more so on the IIROC side of things. So this covers a client's losses of securities and cash balances that result from the insolvency of a dealer member of IIROC. but not a client's losses due to poor investment performance. So each dealer member, they must meet the following obligations. So they must pay IIROC its regular and special assessment. It's just a little bit of money each year that they do have to pay, or each quarter. They must provide the Canadian Investors Protection Fund or IIROC with all information required to assess its financial condition or risk of loss. They must permit them to conduct reviews of its operations and fully cooperate. And they also must comply with actions that the CIPF may direct IIROC to take. Now, the compensation with the CIPF, basically it is funded by quarterly assessments paid by dealer members and risk premiums based on capital deficiencies, as well as annual contributions by IIROC. Now, in terms of the compensation, a limit on coverage, or a limit of coverage on a client's general account equal to $1 million for losses related to securities and cash balances. And then separate accounts are each entitled to the maximum coverage of $1 million. So each account, it does have that limited coverage of $1 million with the Canadian Investor Protection Fund. So next, on the MFDA side, it does have its own sort of investor protection. And on this side, it is called the Mutual Fund Dealers Association's Investor Protection Corporation. And this protects an investor when an MFDA member goes insolvent. Now, the maximum coverage of $1 million per eligible account does apply here for losses related to the insolvency of an MFDA member. And then you also have the CDIC, and this is much different than both the MFDA, IPC, and the CIPF. So the CDIC, it provides insurance for deposits in eligible Canadian banks and trusts, as well as loan companies. Now, these deposits are insured to a limit of $100,000 per person at each member institution. So basically what this means is if you do have less than $100,000, so the limit is $100,000 at a bank, and that bank goes insolvent, then the CDIC will protect you, and you will be able to get your limit of $100,000. Interestingly enough, this actually does apply to each bank. So if you have, let's say, $80,000 at one bank, $80,000 at another, or just financial institutions that are protected by CDIC, and say they both go insolvent, you actually do get your full $160,000 back because it is at two different institutions. Now, moving on to the next slide, we do have to talk a bit about money laundering. And this is a process in which the proceeds of crime are converted into legitimate funds through complex transactions. So you do have three different stages of money laundering. First off, you have the placement stage. This involves the physical disposal or deposit of cash proceeds derived from an illegal activity within the legitimate financial system. So basically, it's getting the illegal money into banks and things like that. You also have layering, and this involves separating illicit proceeds from their source by creating complex layers of financial transactions. And the transactions are designed to obscure the audit trail and hide the original source. This is actually our layering. The layering stage is actually the key risk that dealer members actually have, because that's where people might buy stocks and sell stocks, and it creates just this complex layer of transactions with that illegal money. So that's the highest risk for dealer members. And then you have integration, and this involves placing the laundered proceeds back into the economy in such a way that they appear to be normal business funds. You may use the funds to purchase real estate or business or etc. So by the time the funds do actually reach a dealer member, they will likely have already gone through that placement phase. Since we can't actually accept cash, we can only accept things like checks or electronic transfers. So basically, the money will already be placed into a legitimate financial system, and layering is that key stage that we need to protect against in the financial industry. So next we have the terrorism and terrorist financing. The Proceeds of Crime, Money Laundering, and Terrorist Financing Act and regulations were implemented with the following goals. So first, to detect and deter money laundering and terrorist financing activities, to respond to threats posed by organized crime, and to assist in fulfilling Canada's international commitments to fighting transnational crime. And so anyway, that is everything in Chapter 3 of the CPH course. Again, if you are looking for the next chapter, stay tuned and you can enjoy that one as well. But anyway, make sure to subscribe if you are enjoying these videos, and I'll see you in the next chapter.